I want to bring in Jeff Schulze, who's joining investment strategist at ClearBridge Investments. Jeff, now that we have some economic softening of the data here, in your guys' mind, what does it paint for Jay Powell? Does it become a clearer picture for cuts?
Yeah, I think it is a clear picture for cuts. If you look at the last slowdowns that didn't materialize to an outright recession, that was 95, 98, and then also 2016. Each one of those periods required 75 basis points worth of easing in order to get through that slow patch. If you think about 2016, although the Fed didn't outright cut rates, the markets were pricing in 4 rate hikes that year. And then in March of that year, they decided that they weren't going to raise rates until the fourth quarter. So that was the effect of the 75 basis point rate cut. So I do think that the Fed will cut rates here in October. I think it's something that the economy needs, and it's something to potentially get us out of this slow patch.
Now, this is, I think, a really important comparison because our data now has dropped to the point where really the only recent comparable is that 2015 mini recession, energy crisis. The ISM manufacturing that we saw now is just below where it was then. A lot of the other economic indicators are about at the same level. Do we think that another 25 basis points, Jeff, will have the same effect for risk assets as the pausing of those expected hikes did 4 years ago? Is the efficacy of a 25 basis point going to do it now, given the state of the economy?
It certainly will help. I would feel a lot more comfortable if the Fed cut 2 more times. I don't think that we're out of this current slow patch. And the reason why we say that is that if you look at manufacturing PMI, which is synonymous with the business cycle, the latest print came in at 47.8, which is well below consensus expectations. And this is something, quite frankly, that we're expecting here at ClearBridge. But when since 1950, if you've had no Fed tightening prior to the deceleration of manufacturing PMI, the trough has usually come at 49. If you've had Fed tightening, which we've had for the last 3 years, prior to that deceleration, the average bottoming out of manufacturing PMI came in at 40.5. So we're far point from those levels. And I think another couple of rate cuts would be enough to potentially get us through and have this as a soft landing rather than an outright recession.
Right now, you guys' indicators and your own calculus puts it at a cautionary risk for recession and kind of early stages of cautionary, if I'm describing that right. But you also point out that the ammunition argument for the Fed, I know this has been a debate for a long time, how much that matters. Your point, though, is the average rate cuts are about a 7.5% decline in Fed funds rate around past recessions. Obviously, we're in a little bit of a tighter spot now, but we're not yet in the recessionary camp yet. So how do we sort of weigh those two factors? The idea that data is not terrible yet, but also that we don't have as much ammo.
Well, we don't have enough ammunition to work with, but I think it would be smarter for the Fed to avoid a recession altogether rather than save those bullets for an outright recession and inadvertently cause it because of the lack of rate cuts. The one thing that we've been talking about here at ClearBridge is you have needed about 7.5% worth of rate cuts to get you out of a recession. I think when we do go to the next recession, I think we'll obviously go back to the zero bound. I think QE is going to come back on steroids because our balance sheet is much smaller than what you see over in Japan and then over in Europe. And then also I think they're going to use extreme forward guidance in order to get us through that recession. If it's something deeper like 2007 and 2008, I do firmly believe that negative interest rates will be a talking point for monetary authorities as a potential way of easing additionally from here. That may be a little bit premature, though. The recession risk dashboard at ClearBridge is still flashing a yellow signal, so it's not clear whether or not this is a slowdown or an outright recession. But traditionally, when we've had these yellow signals, we get a very good indication whether the data is accelerating or decelerating about 6 to 9 months after that yellow signal appears. And with the yellow signal appearing in July, that means that the fourth quarter and first quarter of next year are going to be very pivotal of determining the fate of this economic cycle.
With the PPI this morning, another piece of evidence that, at least in the intermediate term, it does seem that the trade discussion, war, whatever you want to call it, with tariffs is putting pressure on U.S. activity. I wonder about the last statement, though, the U.S. catching up to Japan. Is there risk, Jeff, even though after this morning it doesn't seem like there's a whole lot of reason for yields to blow off to the upside? I do wonder if there's still some risk in assuming we know how bad things get, and if we can chart that path to zero rates here when we're still the highest in the world. If the economic data in Europe gets better or China gets better, we mentioned one of the manufacturing numbers this morning that was okay. Is it possible that if we got dragged down in yield due to the rest of the world, because that's the narrative we've heard, right? Is it possible that the U.S. actually could still have a rough patch, but we don't necessarily get that big drag in rates or a bunch of cuts if now the relationship has switched where the rest of the world stabilizes?
Well, there's an old adage out there: when the U.S. gets the cold, the rest of the world gets the flu, and the reverse has never happened, where an outside economy has caused a recession inside the U.S. But
Right.
If you do see a bottoming up of global growth because of this Chinese stimulus that we've seen over the last 18 months, because of the package that Draghi just put into place, that's certainly going to help the U.S. weather the storm here, because we do have some exposure to what international economies are doing, because it's a more and more global market. But again, I'm not sure that we're going to see that bottoming out of global growth quite yet. Our base case is that we're going to continue to see a slow patch and a recession scare over the next 6 months.
Because you guys point in your letter as well, which I think is really good, is that the sort of imported recession is a little bit of a new thing. And we've heard this as the explanation for the drag on yields for 18 months. Well, it's not the U.S. is doing terrible. We can be a little comfortable with the yield curve because German bunds are dragging us down, or, pick your country to blame for our own bond market. So your point, though, is be careful before we assume sort of the inverse of that.
Yeah, with the inverted yield curve, there's an adage out there. People are saying this time is different, and I think those are the four most dangerous words in finance, because usually when those words come out, it's not different after all. What we found is that the 10-year Treasury is not being dragged down by crossover buyers from Japan and Europe because of negative interest rates. Because when you take currency hedging costs in consideration, it's actually not positive for them to do that. It's actually negative rate of return for them. It only makes sense for these crossover buyers to come in at very long-dated Treasuries, which would be 30-year, or spread products like corporate bonds, agencies, or MBS. So we have a chart that looks at the 10-year Treasury versus manufacturing PMI. And post the financial crisis, these are mirror images with one another, which suggests that the 10-year Treasury hasn't been dropping because of crossover buyers. It's been dropping because of a slowdown in U.S. economic growth and some recession fears.
Now, this is interesting because even when we had the U.S. data here beating expectations for a couple months, the economic surprise indexes were taken off to the upside, we were still overall getting that drag. And what you're saying is really interesting, Jeff, because I think it's a little bit of a contrarian view that essentially what's happening in the bond market here is a true reflection of economic risk in the U.S.
It is. And if you also think about credit spreads, they historically lead equity markets. And in the fourth quarter's drawdown of last year, equity markets, lo and behold, led credit spreads into that downturn. So I think one of the areas that are being distorted by monetary policy abroad are credit spreads because of these crossover buyers trying to pick up yield in order to hit their long-term return targets. So yeah, I think the credit markets may be distorted and may not give us the information signal that they traditionally do ahead of a recession. But 10-year Treasuries, in our opinion, is reflecting domestic slowdown and domestic weakness.
This is a really good point. We talked about this yesterday too. I'm glad you bring this up, because if we look at those credit spreads, the BAML chart over the past year, we haven't had the big blowout. And I hear this from the bull case a lot, that we don't need to worry about U.S. fundamentals because this hasn't even gotten to the December 18 levels. It hasn't gotten to close to the 2015 levels. But what you're saying, Jeff, just to make sure our viewers get it, is the Treasury curve hasn't been distorted by the global hunt for yield, but the corporate bond market more likely has. Is that what you're saying?
Exactly.
What does that mean? Does it necessarily mean that we're in for a rude awakening then, if there's some kind of event that causes people to reassess risk?
It doesn't necessarily mean we're in for a rude awakening. Again, we have a yellow signal on the Clearbridge recession risk dashboard, which means this could be a slowdown or an outright recession. There's a lot of positives out there that you can hang your hat on why credit spreads are well behaved right now. Non-performing loans at banks are healthy. Delinquency rates, even though they've ticked up, are nowhere near recessionary levels. lending standards are still very easy. So there's a lot of reasons to hang your hat on this being a slowdown, but I want to look at credit spreads as giving you the same information value and the same lead time as what you've traditionally seen over the past 7 recessions. It's still an indicator in our dashboard, but it's an indicator that we're looking at a little bit more scrutiny because of the lack of awareness that it gave us going into the last downturn in fourth quarter of last year.
Jeff, really important take and a really interesting one here. Love to hear analysis that isn't the same old stuff. Jeff Schulze, really good work, Jeff, investment strategist at ClearBridge Investments.